So you ran your comps, you got your comp report, you selected your ARV comps, and now you want to calculate what your offer should be. So we have three types of offers you can calculate when you do ARV comps. You can calculate wholesale, flip, and BRRRR offers, and I'll go over all of them in this video. And if you run as-is comps, you can also calculate creative, novation, and buy and hold offers, which I'll go over in another video. So I'm going to start with the wholesale deal. So for the wholesale deal, we need our after repair value and our estimated repair costs, which we can set to a custom dollars per square foot, or you can use the repair cost estimator. So in this example, I asked the repair cost estimator for a new roof, new kitchen, and new bathrooms. It did a bunch of research online, and it figured out that this should cost about $42,000 in the city of Adelanto. As you can see, the property needs a lot more than that, but just for the sake of example. So we have our estimated repair costs, and this is the desired assignment fee. Here you have our MAO percentage. It's suggesting 65% because this market is a bit slow, but if it was a hotter market, it might suggest 70, 75, or 80%. So based on this, it's calculating a maximum allowable offer of $107,000 or $108,000. But obviously, we should not start with that. So it's suggesting maybe making an initial offer around 102K. And it's suggesting we could sell it to a buyer for $123,000. But we also have a more advanced flip calculator. So we still use our after repair value and the same estimated repair costs. And you can decide to input your purchase price and calculate the profit, or input your desired profit and calculate your maximum offer. So I'll do this example calculating the profit. So first we have the financing. You can choose what to finance. So I can say this is a hard money loan for the price and the rehab. And that would mean the loan amount is 137K, 25% down payment, let's say a 10% interest rate. Lender points are what you pay upfront to have a reduced interest rate, and then the loan term is here. I'll just leave it at 30 for now. And then holding costs, we calculate this data from the public record, and then this is what's very important that you should change. This is how many months you think it'll take you to rehab. So I'll say 3 months for this property. And so here are the transaction costs, which these are the transaction costs for the buying and selling the property. So you can set these here, and here's the purchase price. And so based on all of this, we get a total profit of $45,000 if we're able to buy it at 140K, the 17% profit margin, and it goes over everything else down here. So finally, we have our BRRRR offer, which is buy, rehab, rent, refinance, repeat. And so this is like a flip, but instead of selling the property after you flip it, you can rent it out and have a cash flowing asset. And now that it's been rehabbed, it'll appraise at a much higher value. So you can go to the bank, take out a mortgage, and even pull money out of the deal, possibly pull more money out of the deal than you put into the deal. So we still use our after repair value here and estimated repair costs here. And I'm going to go down here and show you the timeline of what this deal looks like. So we have our purchase price, and then the loan financing you input here. It's the same input used in the flip calculator, which I went over, and I've selected to finance the price in rehab with a 25% down payment. And then here you have your rehab, so we use the repair cost here, and the holding costs are here, and you can input how many months you're holding it for here. And then step 3 is rent. So you're probably going to rent it out a bit before refinancing to demonstrate cash flow. So monthly rent, we're estimating to be about $1,800. Operating expenses you can customize here, and we assume a small vacancy as well. And then your loan payment is still the same loan used for purchase financing. And then step 4 is refinance. So now you'll be able to get it appraised at a much higher amount. We estimate you'll get it appraised at the after repair value. However, if you think that you're not going to be renovating it to the extent that the comps were renovated, you can come in here and input a lower value here. And then you can come over to refinance terms and customize the terms. So we're assuming this is probably going to be a traditional mortgage. The costs that you have to pay immediately are paying off the other acquisition loan and the refinance closing costs. And after all of that, you get about $52,000 out of the refi. And if we also subtract the price you paid out of pocket up here, then you're able to take out about $2,000. So it's a pretty good deal because a few months into it, after refinancing it, you're already profitable on this deal. And now you can start cash flowing every month. And now you have a new monthly mortgage of $1,000 and a cash flow of $274. So the cash flow on this property is pretty low. If you think we got the rent estimate wrong, you can change it here, but this deal would work better in an area with higher rent. Sometimes you can also get higher rent by doing a short-term rental, but this deal can be really good because you have a cash flowing asset, you took money out of it, and now you can put it into another property, which you can BRRRR. So that's how to calculate your wholesale, flip, and BRRRR offers on ChatARV. If you have any questions, let me know in the comments. And there will be another video for novation, creative, and buy and hold offers, which come from ads as comps, and you'll find them on our YouTube page. Thank you.